Thank you, everyone, for joining us this evening for this webinar on dissecting the put spread. We're going to go over this topic in great detail in just a second. But before we do that, we want to provide a little background on how this webinar will be conducted and then a little background about ourselves. As for this webinar, it's going to be held for the next hour. And if you have any questions, we encourage you to put it into the Zoom question area. You should see a little question box at the bottom of the Zoom panel there. We encourage you to put your questions there. If you have anything else, you can put it in the chat, but any questions, please put it in the question area so we can monitor that correctly. Ernie will be monitoring the questions throughout the presentation, and he'll try to answer as many as he can. And then we will have a Q&A after the presentation. I have a tendency to talk a lot during this type of webinar, so we're going to do our very best to answer as many questions as possible. So don't be shy. Put your questions into the question area as they pop in your head throughout the webinar. With that said, let me provide a little background about myself. If you're new to our webinars or new to Dorian Trader, my name is O'Brien, and I have been trading the markets literally since I was a senior in high school. I got introduced to the markets by an economics teacher, and that economics teacher had us follow stocks from the newspaper and also showed us the first Wall Street movie with Michael Douglas. At that time, I convinced my mom to buy me a computer, and I started day trading penny stocks from dial-up. I was that excited and that motivated to get started. I used a company called Daytech back then, which was eventually purchased by TD Ameritrade, which you all know was eventually recently purchased by Charles Schwab. But I've lost a ton of money, or at least what was a ton of money to me as a senior in high school, trying to learn how to day trade penny stocks. And I realized that wasn't for me, but I still had the bug, and I knew one day I wanted to play some significant role in these markets. So if you fast forward several years, I eventually became a registered investment advisor. I held the license 65 for registered investment advisors and then license 3 for commodity pool operators. I needed those two different licenses to run a volatility hedge fund that I did for a decade. And I'm now the CEO of Dorian Trader, which is an options mentoring firm that specializes in teaching individuals how to trade options. That's why we're obviously doing this webinar. And so we'll talk about the Dorian Trader a little bit later, but for now, I'm going to have Ernie introduce himself and then we'll jump into the meat of this webinar.
Well, Brian, thank you. Good evening, everybody. If you're sort of in the United States, if you're elsewhere, good morning or wherever, whatever time it is. I just realized something, O'Brien. Even though I'm a CPA, retired, still in business, pharmaceutical space, been in doing this for 40 plus years, I'm the teenager. I'm the teenager between the two of us. I've only been trading for my teenage years. So even though I've got the gray hair, you've got more experience and knowledge than I do, and which I knew, but that's the way I'm going to think about this relationship that we have, even though I'm the elder biologically. You carry a lot of weight when it comes to experience, not only in trading, but in teaching. And I appreciate that a lot. We've been doing this for the last 6, 7 years. I've been trading options for about 12, 13 years. It's been super fun, not only trading, making money, but mentoring other people, building this trading club that we have that I'm sure O'Brien will talk to us about. My first trade was in Chile stock, EAT, way back in the day, probably I think I had to call my broker. That's how old I was. I had to call my broker, and the commission on 100 shares of a $20 stock was like $50. Can you even put your head around that? That's old school, but we're not going to go there much more than that to laugh about that. Let's get a poll. God, we have a lot of people on the call. Just jumped on like crazy. I want to get everybody involved very quickly. O'Brien, I am looking at
You
all
don't
our
see the
little
you don't see the poll.
controls. I
I,
see no
I'll,
poll.
I'll, I'll launch it then, Ernie.
Okay, great.
All right,
Great.
so here we go. And you
That
see that,
should,
Ernie?
I see it. I
Okay.
see it. How familiar are you with option trading? Let's get everybody involved here. Your choices are simple. O'Brien, I'm not seeing any voting coming through.
I am.
Oh, you are? Okay, good.
Yes,
Okay,
yeah.
good.
So,
Gotcha.
so a bunch of voting. Right now we got 100% people.
That quick. Holy cow. There's a lot of people on the call too. Wow. Oh,
I'm
all right. You
joking. We got 70% of the people.
okay? Well, that's still a lot too, based upon the number of
Yes.
calls. And we're live on YouTube as well. So, golly, we got a lot of folks on the call. That's great. Appreciate you guys spending your time with us. I know that O'Brien is going to, no pun intended, dissect that put spread, which is it's a just a great trade. Simple trade once you understand options, but a great trade.
Awesome,
Absolutely great
absolutely.
trade.
So I'm gonna count down from five, Ernie, and we'll close this poll. So we got five, four, three, two, one, and I'm gonna close it, and then I'm going to share the results. And And so we had about
Yes.
43% of the people said some basics, 11% is new. So great to have you. And 32% of you are comfortable. And then we got about 14% that is advanced.
Advance.
So we're going to give you something. We're going to give everybody something. But obviously for us, you guys, we believe this put spread is a basic strategy. So we're going to go over that. But trust me, if you are advanced, which some of you are, 14% of you, that you're going to learn something new here. Just stay with us, and you'll definitely learn something new this evening. All right, so I'm going to stop sharing this, and I'm going to close this poll, and Ernie's going to turn off his camera, but he's going to be in the he's going to be monitoring the questions throughout the presentation, throughout the webinar. So we encourage you to put your questions into the question area of the Zoom panel. If you're watching us from YouTube, we encourage you to put the question into the YouTube question area. We'll see if we can answer as many as we can there as well. But keep in mind, it is a delay, a slight delay from the live YouTube stream.
Yeah,
So
YouTube chat. Put it in the chat there. I don't think there's a Q&A in the YouTube
correct,
for
you're going to
just
put it in the
chat.
chat area and on
Perfect.
YouTube.
All right, and for those that are online with us, I'm going off. My camera's going off, but just test the question box for me. Put the city that you're calling in from. See you in a little bit.
Awesome. So if you can, yeah, if you put the city that you're calling in from on in the questionnaire, just to make sure you know where that questionnaire is at and things like that. And then we can kind of get a feel. We always like to see how many people are, all around the United States and all around the world. So as you can see on your screen right now, we do have a few other main team members. We have Dr. Meadows to the left of Ernie here. He's one of the owners, and obviously Ernie's one of the owners of Dorian Trader and myself. And then we have Owanza, who is an amazing teacher. We got Eric, who's an amazing teacher. Gustavo is just a superstar, and we got David, that is also a superstar. So you'll be able to meet us all if you decide to join the Dorian Trader, be able to meet us become very, very good friends, very close, because we allow our members to be able to unmute their mics and ask questions throughout the live kind of teaching classes that we have and member only kind of classes that we have. And we're always interacting in person and then obviously online through Zoom type of meetings. All right, so this is our team. We do have some other people that's not on this slide here, but you will mainly get to know the people that's on this slide. All right, so let's start off by talking about the basic options. You guys, we're going to spend very quick time. We're going to spend about 10 minutes on the basic options to set up this dissecting the put spread. Okay? So what are options? Options are contracts called puts and calls. A standard put or call represents 100 shares if you're trading stock options. If you're trading options on futures, which we teach also here at Dorian Trader, it does not mean that. Options can be bought and sold at different standardized strikes on an option chain. We're going to go over the option chain in just a second. All options have an expiration date, so options can expire today, tomorrow, or years from now, but they will expire. Time is always ticking when you're dealing with options, and that's the kind of built-in leverage for that's included in options. You something has to happen within a certain time frame because it will expire. Okay? So here at Dorian Trader, we believe it's three pillars to the base of options. You have the first pillar, which we're showing here on our screen right now. That is what is a call and a put and what's happening when you buy and sell a call and a put and what's rights and obligations. We'll go over that briefly. The second pillar is what is the option chain and how do you use the option chain? Because that's how you literally buy and sell calls and puts. We'll go over that in a second. And then the third pillar is what is basic option strategies. And because if you understand the basic option strategy, you'll be able to understand all the different exotic strategies that are created out there because they're just a deviation from the basic strategies, right? And so the, here with this dissecting the put spread, that is a basic strategy. It's a very simple strategy, but if I had to pick any strategy out there, if it was if I can only trade one strategy, it would be the put spread. It's simple, it's basic, but it's a powerful strategy, and hopefully we'll be able to get that across to you this evening. Now, going back to the first pillar, what is a call and a put? And so we have this image here that we like to break down into two sides. So if you are the buyer of an option, you want to consider yourself the purchaser of insurance. So we're going to use the insurance analogy this evening because it mirrors trading options almost 100%. So if you're the buyer of an option, I want you to consider yourself someone going to Geico and buying insurance. If you buy a call option, you are bullish, as this arrow indicates. You want it to go up. Monies are coming out of your account to pay for that option, and you need something to happen within a time frame. You need a big move to happen within a time frame, or you're going to most likely lose all that premium or most of it that you paid. If you are the buyer of a call, you have a right to purchase at a strike price, but not the obligation. You have a right, but not an obligation. Now, this is what most people use to start options with, or one of the main things. I say this is number one because it mirrors the buying of shares the closest. Meaning that if you buy shares, you want it to go up. If you buy a call, you want it to go up. And so most people start with option trading with buying calls. So it's basic. Now, if you buy a put, you are paying monies and you are bearish, as this arrow indicates. Once again, you're going to like Geico and buying insurance. You're buying a put and you're bearish. Monies are coming out of your account. Now, this is where it becomes confusing to almost everyone instantaneously when it comes to trading options because you're buying something and you actually want it to go down. That's counterintuitive to what we are accustomed to. Normally, when we're buying something, we want it to go up in value. But with options, if you're buying a put, you actually want it to go down in value. That's how you win. You're bearish. So it becomes confusing to people instantaneously. If you are the buyer of the put, you have a right to sell, but not an obligation. You have a right to sell at a strike price. That's the kind of textbook definition. Now, once again, if you're on the left-hand side, the buy side, you are the purchaser of insurance. If you are on this right-hand side and you're the seller, then you become a one-woman or one-man Geico operating in the open market, right? You become a one-man or one-woman insurance company operating in the open market. You literally become an insurance company. Now, some of you've already realized that you'd rather be the insurance company than the buyer, right? You'd rather be the insurance company than the buyer. But as I indicated earlier, most people start with options as being the buyer. You're the buyer of the call. And then what will happen is that you will buy a call and you're underlining that stock that you bought the call on will go up and you will still lose money. And that would be so frustrating to you and you'll think the game is rigged and you'll go away from options. You'll go away from the markets perhaps. And that's sad because you'll be doing yourself a huge disservice because it's nothing like options. It's nothing out there, in my opinion, to make money like options. You can make a ton of money trading options, but you have to understand what's happening when you're the buyer and what's happening when you're the seller. When you're the buyer, you are purchasing insurance, and when you're the seller, you are the insurance company. You have the odds on your side. We also like to use the analogy as the casino. You either the person sitting down and going up against the house, or the dealer playing blackjack, or you are the dealer, you are the house. Most of us, once again, instantaneously, we would rather be the house because we understand they have the odds on their side. Well, once you learn how to trade options correctly, you'll understand how to put the odds on your side the super majority of the time. So if you are the seller of a call, you are bearish. You want it to go down as this arrow indicating. Monies are coming into your account instantaneously. Someone's paying you premium to sell the call. And so the one of the questions that pops up is that how can I sell something I do not own? Well, you are the insurance company. You are creating what you are selling because the contract, it's literally a contract that you're selling, does not exist until you sell it. So just like if you go to Geico and you don't have a policy with them, they have to create that policy. And then you have to sign it and they have to sign it. Well, that's exactly what's happening in the open market. The option that you sell does not exist until you sell it. And you get to determine how you're going to sell it, all the details around how you're going to sell it. So the seller of a call is bearish, and you have an obligation to sell shares at the strike price. So that's different than the buyer. The buyer has a right to purchase. So someone has to have the obligation to sell to the buyer if the buyer has the right to purchase. So that's what's happening here. So if you're the buyer of the call, you're bullish. If you're the seller of the call, you're bearish. And so it's just the circle, right? You can be bullish or bearish just using a call. Just depends on what you're doing. If you are the seller of the put, then you are bullish. Monies are coming into your account and you have an obligation to buy at a strike price. Now, this is probably the second most option strategy that people start with, and that's selling a put. It's called selling a cash secured put and okay with owning the shares. This is what a lot of people start with. This is probably 1A. Very, very conservative strategy if you're doing it correctly. You sell the put, you receive monies into your account that you never have to give back. Selling a put, you're bullish. You have the obligation to purchase because if you are the buyer of the buyer of the put has the right to sell. So if you have the right to sell something, then someone has to take the other side. Someone has an obligation. And so that's how you can be bullish or bearish using only a put as well. It all depends on if you're buying it or selling it. What if you're buying it, you're bearish. If you're selling the put, you're bullish. This is very, very important to understand. You have to understand the foundation of options trading. So today we're going to be talking about this put spread. We're going to be talking about selling a put spread and buying a put spread. Simultaneously, we're going to be buying a put and selling a put. We're either going to be the purchaser of the put spread or the seller of the put spread. So if we jump over here to this Tasty Trade platform, I'm going to show you an option chain. I'm going to do this quickly because I've already been yapping a little bit too much. I'm going to go to this May the 15th. And what I want you to understand is when you open up an option chain, calls are to the left. So all of these are calls to the left here. And to the right are puts. All of these are puts. And then going down this middle area here, going down this kind of vertical line here, these are what is called the standardized strikes that I mentioned earlier. These are the strikes that are created by the exchanges like the NASDAQ exchange or the New York Stock Exchange. They create these strikes and you can buy and sell at these strikes. Now, if you look at this orange horizontal line going across the Tasty Trade platform, this right here is what is called the at the money line, the ATM. This is where the stock is currently trading. So you should always know where the at the money line is. Here at Dorian Trader, we consider it the baseline, the equilibrium. You either going towards it or going away from it. You always need to know where the at the money line is at. And it's easy because it's just where the stock is currently trading. So I'm looking at the SPX here, and it was trading at 65.95 when it 65.91, I should say, when it ended. So it's basically in this area here, right? That's the at the money. Once you know where the at the money line is, which we should all know because this is where the stock is currently trading, then you can determine the in the money and the out of money area. So on the call side, above the at the money line is the in the money area, the ITM. Below it is the out of the money area, the OTM. And then it's the opposite on the put side. This is the out of the money area or the OTM, and this is the in the money area on the put side, the ITM. So it's very, very important that you know that where the at the money and in the money and out of the money area is at, because we have what we call rights and obligations that we talked about. And if you're going to exercise your right, it's most likely going to be in the money. If you're going to have to live up to your obligation, it's most likely going to be in the money. So it's important to know where you're at the on the option chain. And then if you're going to have ridiculously, or if you want to have ridiculous probabilities of winning on the trade, well, that's going to be done in the out of the money area. So you want to know where you're at on an option chain. Also on an option chain, you want to know the ask and the bid, which is on both sides. Once again, the call side is the left-hand side, the put side is the right-hand side. The ask is where you buy at. And on the platforms we recommend almost 100% of the time, the green represents buying. And if you click on the bid, that represents selling. And almost 100% of the time, that's red. Right? So we're going to be buying and selling puts today. Okay. Now, also on an option chain, you want to know delta. Okay, and delta's on both sides. Delta's one of the four major option Greeks. You have delta, gamma, theta, and vega. You want to know delta. If you do not know any of the other ones, you want to know delta because delta is crazy important. It's super important. I like to say, to emphasize this, that you don't even have to know any other option Greek, and you can still be successful if you understand delta, because delta measures two important things. The two most important things when it comes to trading, in my opinion. Number one, delta measures your directional risk. What can be more important than that? Number two, delta measures your probability of success, your probability of winning. What can be more important than that? So they equally as important. And delta measures both of those. Delta gives you that gauge for both of those important things. So if you had 100 shares of whatever company, right? Let's just say, let's just switch this back. Let's switch this over to SPY. And let's just say if you had 100 shares of SPY. Do this again real quick. If you had 100 shares of SPY, that means you would have 100 deltas, because each share that you own equals one delta, and it will stay static, meaning it won't change unless you increase the amount of shares you have or decrease the amount of shares you have. If you stay with 100 shares, you will always have 100 deltas into perpetuity. No exceptions to that rule. Okay, no exceptions to that fact. So if you have 100 shares and it goes up $1, you're going to make $100 because delta measures how much you will make or lose based on a 1 point move when it comes to directional risk. So if it goes down $1, you're going to lose $100. Okay, because delta once again measures how much you will make or lose based on a 1 point move. Now, when it comes to option delta is dynamic. That means it changes. It's always going to change. It's never going to stay the same. But when you initiate the trade, let's say you initiate the trade at a 45 delta, well, what that means is going to move 45 cents for every $1 move. Okay? Or if you initiate at a 75 delta, that means it's going to move 75 cents for every $1 move. It can move dollar for dollar or 100, right? If you had a delta like that, it can move dollar for dollar, but it will move. It can go up or it can go down. It's always going to move 100% of the time. At expiration, the delta is either going to be zero or it's going to be 100. If it's 100, it's in the money. If it's zero, it's out of the money. Option delta is always changing, so you'll know what your risk is at every step of the trade. Right now, it's saying that I my delta is 45, so it just means that it's changing 45 cents once again for every $1 move up or down. Okay, so I don't have a lot of time to go into this in great detail, but you want to understand this. If you join Dorian Trader, you're going to learn this at a super high level. We talk about it all the time. Okay? So as for probability of success, because delta also measures that. If we go back to this at the money line here, this orange horizontal or brown, whatever color you consider it, this at the money line, once again, this is where the stock is trading. If you buy or sell something at the money, you're basically going to have a 50-50 shot, a coin flipping chance of making money if you buy or sell something at the money. Technically, it's less for the buyer and a little more for the seller, but I want you to think of buying options at the money like it's like buying shares, because if you buy shares, it's either going to go up or go down. 50-50 shot, at least initially. Over time, it might drift up like the S&P 500 or this SPY that we're looking at. But if you're going to buy at the money initially, it's a 50-50. That's just pure statistics, right? So I want you to think of that as options when you're buying or selling options. At the money is a coin flip. And that's not bad, right? It's better than something less than a coin flip. But where the odds change and change dramatically for the option seller, the person acting as the insurance company, the person acting as the casino, is out of the money area. So as we mentioned on the call side, below the at the money is the out of the money area, the OTM. And on the put side, it's over here once again, the OTM. So we're going to be focusing on this put side over here. So what I want you to understand is that if I if I decide that I'm going to, let's say, buy this 40 delta option, if I buy this 40 delta option out of the money, the option that the delta I buy at is giving me my probability of success. So in this case, I would have a 40% chance of winning at least something, at least 1 cent at expiration. That's what option probabilities are based on. It's based on the time of expiration. So in this case, we have 51 days. Sorry about that. We have 51 days to expiration here. And so it's not a second before or a second after expiration. Literally, the probabilities are based on expiration. So in this case, if you're buying a put out of the money at a 40 delta, you have a 40% chance of making money at expiration. Doesn't mean you can't win or lose before it, but if you wait to expiration, it's going to be a 40% chance. And this has been proven over time, over study after study, that this is correct. So if you did 100 times, you're gonna lose 60% of the time. If you did 100 trades, you're gonna lose 60% of the time. Now, but if you're the seller of that same strike, if you're the seller of that same strike, then it's the inverse. So instead of having a 40% chance of winning, you're going to have a 60% chance of winning at least something at expiration. Because what happens when you are the seller of an option, you receive monies into your account. And then it has to supersede that amount you received before you lose. So for example, this is the at the money line again. If it drops, and this is going down on an option chain, if it drops and hits this 645, you don't actually lose there yet if it's not expiration, or even if you might be down before expiration, but at expiration, you're not going to lose if it's at the 645 strike, because someone has paid you $15, let's just say here. So you don't start losing until it drops below 630, because it has to supersede the money someone paid you. Just like I told you earlier, the car insurance analogy. If you go to Geico and you pay Geico $1,000 to insure your car for 6 months, and you have $1,000 deductible. If you get in a car accident and your car accident is less than $2,000, Geico does not lose on you because your accident has to supersede the $2,000 that you're liable for, that you have an obligation to pay. Okay? That's the same thing that's happening in the option world based on the premium that you receive. You have you have great odds because of the premium that you receive and the delta that you're selling at. Okay. But it's something called probability of touch, and it's two-time delta. So in this case, if you're selling something at a 40 delta, the probability of touch is 2 times 40, right? So that's 80. So you got an 80% chance within the next 51 days, it's going to touch this strike. And if you don't understand that, you're going to bail on the trade and you're going to lose. But if you wait for expiration, you're going to win 60% of the time. But we don't like to be fooled by randomness. We don't like to be fooled by deltas. We don't like to be fooled by probabilities here at Dorian Trader. So we understand the whole picture. And so we don't sell things at the 40 delta if we don't want to own it because we don't like to be touched. We don't like to be challenged. In this case, you're going to be challenged. 80% of the time, you're going to be challenged on this trade. So what we teach is selling things that you most likely are not going to be challenged on. And so if we sell this put at the 10 delta here, well, it's the inverse. So we have a 90% chance of making something, winning at least 1 cent at expiration. And if you do the probability of touch, that's 2 times the delta. So 10 times 2 is 20. So we only have a 20% chance it's going to be touched here. So an 80% chance it's never going to touch this 570 strike within the next 51 days. That's the type of trading we teach here at Dorian Trader, to have significant odds on your side, but still collecting a good amount of money for the risk that you're taking. Being the insurance company, being a casino, making sure almost every trade we do, we have super high probabilities to win. And then on top of that, we teach you how to adjust so you can even increase your odds even more. But if you do not know how to adjust, which a ton of option traders out there do not, you still need to understand the probabilities. You still need to understand the odds. You can't just push buttons and not understand your probabilities. Trading is a probabilistic game. Play the game correctly. It was Denny Green, I think it was Dennis Green, the football coach for the I think it was the Vikings or something like that. And he used to say, "You play to win the game." It's the same thing with options. You play to win. You play to make money. This is not for fun. It's not for giggles. It's not for entertainment. Yeah, it can be all of that, but it's black and white. You're either making money or you're not. So you have to play to win the game. All right, so let's jump back over to this PowerPoint. I want to point out that we do have a YouTube channel. We're streaming there live right now, but we encourage you to subscribe to our YouTube channel. If you do that, you'll be able to learn a ton about the base of options. We obviously couldn't go over it in much, too much detail this evening, but go to our YouTube channel, learn a ton about the base of options and so much other stuff. Leave a comment. We answer all comments. So subscribe to our channel. Go to YouTube, type in Dorian Trader, subscribe to our channel, watch the videos, leave a comment, hit a like. So support us that way. We appreciate it. All right, so let's move on. And I want to point out to you guys that later on in the call, we're going to give you an offer to join us for $30 per month with the code START NOW. $30 per month for a 3-month trial. After that, it's $125, but we believe this is a shocking offer and it's an amazing offer. And you kind of got the cadence of how, or the dance of how we teach, or at least how I teach. Don't want you to say yes or no now, but if you learn something tonight, and if you like my teaching style, strongly consider join us. We would love to have you a part of Dorian Trader and build upon what you've learned tonight to make money. So let's jump into this. What is the put spread and what are its mechanics? The put spread is when you buy or sell a single put and at a strike price, excuse me, and simultaneously sell and buy another single put at a lower strike price. So for example, you sell a put at the 100 strike price and at the same time you buy a put at the 90 strike price. This is a 10-point wide put spread. This is the kind of mechanics of it. Okay, it's a 10-point wide put spread. It looks like something like this. Okay, it looks like this. I'm going to just do a 10-point wide here. Let's do one here and here. This is a put spread. This is the selling of a put spread I'm showing right now, but we're going to go over this in detail. I just want to break this down first. A put spread consists of two legs. It's never less and it's never more. So this is considered one leg and this is considered one leg. And so if you add that up, that's two legs. It's always two legs, two option legs. You're going to have one that you're selling and one that you're buying. And in between the spread, whatever that width is, in this case, the width is 10 points. If you're using options on stock, it's always going to be $100 per point. So in this case, this is 10 points wide, 60-50, 60-40, 10 points wide. So 10, so 100 times 10 equals 1,000. This put spread, the value of this put spread equals $1,000. That's the value of that spread. If we did a spread that was 20 points wide, then this value of the spread would be $2,000. If we did a put spread that was worth 30, or that was 30 points wide, it would be $3,000, $100 a point. Okay, you want to understand that. That's the basics of a put spread. Okay, let's jump over here really quickly and let's continue. So it's two type of put spreads. The first one we're going to talk about is what is a long or bear put spread. A lot of times you're going to hear someone say long put spread or bearish put spread or bear put spread, right? What is it and why should we use it? The long or bear put spread is a vertical spread strategy, vertical meaning up and down, that creates a net debit in your account, meaning that you're paying monies. Monies are coming out of your account, as we talked about earlier. The option you buy is always more than the option you sell. That's why it's a debit. The bear put spread is used to short an underlining or to hedge against a bullish position. So let's go and talk about this real quick. So let's say we had this spread on right here. This is the spread. This right here is the at the money line as we talked about. The put that you're buying is closer to at the money. So it's going to be worth more. It's a higher delta, as you can see, than the put that you're selling. That's further from at the money. And it's going for less money. Okay? So this is going to be a net debit. And so what you're trying to do here is that you're trying to make the monies between the spread here. As we talked about, this is a 30-point wide spread. So the most you can make here is $3,000 if it drops a lot. The most you can make is $3,000 minus what you paid. So if you go down here, Tasty Trade is an awesome platform. It gives you all this, but you need to know how they're getting this information. So in this example, let's just say we're paying, just for easy math, we're paying 750 here. Right? We're paying 750. The spread is worth 3,000. So if you take 3,000 and you minus 750 from it, you're going to equal this right here, which is the 2250, right? That's the most you can make, as Tasty Trade is pointing out here. Your max profit is 2,250. The most you can lose when you're the buyer of a put spread, that's what we're talking about. If you're buyer of an option period, the most you can lose is what you paid. So the most you can lose here is $750, and that's what Tasty Trade is saying here, the max loss. The buying power you have to put up is your max loss, which is the 750. That's the buying power. That's the collateral you have to put up to be able to do this trade. And so Tasty Trade is telling you down here that you have a 42% chance of making something at expiration. Right? That's not great odds. That's less than a coin flipping chance of winning. That's at expiration, and option probabilities are based on expiration. I can't emphasize that more. It's based at the time of expiration. You can win and lose before then. So, for example, Tasty Trade is saying you have a 54% chance of winning 50% of this, 50% of what you paid in the next 51 days. So, if you don't hold to expiration, you're going to have a little higher than a coin flipping chance if you don't hold to expiration. But if you're the buyer and you hold for expiration, it's always, if you're going to do a put spread out of the money, it's always going to be less than a coin flipping probability. Okay. You want to understand that. This is a bear put spread. Let's jump back over here and let's talk about what is a short. This is like when you short, it's like selling it. What's a short or bull put spread? And why should we use it? The short or bull put spread is a vertical spread up and down strategy that creates a net credit in your account. So monies are coming into your account. Now you're acting like this, like the insurance company again. Now you're acting like the casino again. The option you sell is always more than the option you buy. Now, so you're selling something for more than what you're purchasing. The bull put spread is used to make money as the underlying goes up. It can also be used to offset short positions, right? You got a short position on, you put on a bullish position, that's offsetting it. If we jump back over here and we use the same type of example, but this time we're going to flip it. Okay. We're going to flip this options here. And so now this is the at the money line that we were talking about. Now the one that you're selling is more, it's closer to at the money and more than the one that you're buying. So you're buying one that's, let's say, around 9 something, and you're selling one that is around 16 something. Okay. So if we change this for easy math again and put this at 750, now in this example, if you're the seller, the most you can make on the spread is what you sold it for. So 750. That's your max profit. Tasty Trade is giving you here, 750. So it's the flip. This spread, as we talked about, is worth 3K. So you minus 750 from that. So your max loss now is 2250. When you were the buyer in this example, that was your possible gain, right? That was your possible gain. That was the most you can gain. Now, because this is your max loss, that's the buying power you have to put up. This buying power effect, the collateral you have to put up is 2250 to do this trade. But as you can remember, when we did these same strikes, but we were buying it, we were purchasing this spread, the probability was 52% at expiration. In this case, it's 58%. Tasty Trade is saying. You got a 58% chance of winning at expiration. If you go by the delta, you take the 100, you minus 44 from it, that's 56%. But it's that if you go by the delta, and I like to go back to delta just in case you didn't have that, you can say a 56% chance. Still better than a coin flipping chance, but it's technically a little bit more than that because of the premium that you have. That's why Tasty Trade is saying 58% here. That is that is great. That's better than less than a coin flipping chance, right? Or it's better than anything less than 58%. But look at this probability of making 50% at expiration. That jumps all the way up to 86%. So if you don't hold this to expiration and you get out once you've won 50% of what you can make, you're going to win 80 plus percent of the time on that trade. It's understanding the dynamics of option probabilities, understanding what you need to know to be able to make money consistently. All right, so let's continue. So, what is the best way to use a put spread to go long the market? So, long the market is bullish. Okay, that's what that means. The best way to use a put spread to go long the market is to make sure the probabilities are on your side based on the strike prices you use. We believe that is a delta between 5 and 15 here at Dorian Trader. So you either have a 95% chance or an 85% chance of winning something at expiration. That's what we consider going long. That's the best way to go long. That's the best way to be bullish. What we believe here at Dorian Trader. We'll show that more here in a second. Now, what is the best way to use a put spread to short the market? This is being bearish the market. Okay. The best way to use a put spread to short the market is to make sure the probabilities are at least 50-50 by buying a spread at the money or a little in the money. Right? So what I mean by that is that if we're going to be bearish, we're going to short the market, we're going to buy something. It's going to be technically less than 50-50, but this is, you can just consider it, as I said earlier, for simplicity purposes, 50-50 shot if you're buying something at the money. So let's just say we were going to buy this put spread here. Well, Tasty Trade is saying your probability of winning at expiration is 49%. So that's semantics, right? We'll say 50% chance. So that's at the money. If you buy it a little in the money, then now that's that 50% chance that you have here. Tasty Trade is saying, okay, and that delta right here is saying 50% chance at expiration. So you have to understand how to place the trades. If you are thinking that you're going to make a lot of money by buying a put spread way down here, well, you're being disingenuous or you are ignorant to what you are doing. And we've all been there. I know I have been there. I told you earlier if you were on the call earlier, that I started trading penny stocks. I just started pushing buttons because I was so excited to get into these markets. And I knew Jack. I knew little. I knew less than Jack. It's no excuse these days, though. It's no excuse. You can find the right mentor and you can learn this without just willy-nilly pushing buttons. This is how you go. This is how you be bearish. You want to understand your probabilities. So, how do you use a put spread to hedge? The best way to use a put spread to hedge is to use a starting strike price that provides a good hedge for at least the amount of capital and that provides a realistic chance of making money on the hedge if used to protect the bull put spread. So here at Dorian Trader, we believe that's at or near the 30 delta. It's a really good balance. And so let's just say this is the 30 delta here, and let's say we were buying a put spread here to hedge. Well, if this was a 30 delta, then what it means is that 30% of the time it's going to expire worthless, okay? Out of the money. But 60% of the time it's going to touch this strike price. So that gives us a chance to actually make money on our hedge and the trade we're trying to hedge. Even though we're not trying to make money on the hedge. The hedge is a hedge, right? But this gives us better odds and it costs a lot less than buying a hedge at the money or in the money. Okay? You'll learn that one of the hedges that we teach here and do often here at Dorian Trader, you'll learn that if you decide to join us. All right, so we're going to do an experiment here. Is it better to sell a put spread in the SPX cash settled index or in the ES options on futures? They're the same thing. They're the S&P 500, but which one is better? Before we do that, let's talk about how we can help you here at Dorian Trader. We can help you sign up with a brokerage firm, Tasty Trade, Thinkorswim, or Interactive Brokers. These are the three we recommend in that order. So if you can get Tasty Trade, do that. If you can get Thinkorswim, if you can't get Tasty Trade, get Thinkorswim. If you can't get either, then you go to Interactive Brokers. We can help you not only sign up with these brokerage firms, but we can help you set up the platform so it can mirror ours. We can help you make 2 to 5% per month or 24 to 60% annualized. This is our value proposition here at Dorian Trader to help you learn to make money to at the very least, supplement your income in a meaningful way. And if you have bigger aspirations, we can help you be a full-time trader. So, no, we can't guarantee that. We're not saying that. We're not charlatans. But this is what we say to our members. Once you learn the process, and if you're not making at least 2% per month, then come to us and let's figure out why that's the case. And if we can't figure it out, you shouldn't be with us because it's all about making money. We said earlier, you play to win the game. You play to make money. Trading is black and white. You're either making money or you're not. There's no gray area. There's no I woulda, coulda, shoulda stuff. We want to help you learn to at least supplement your income in a meaningful way. It's nothing like options out there, you guys. It's nothing like options out there. We can teach you the basics, find trade ideas, understand your portfolio, how to use proven trading strategies. We can help you manage directional risk with deltas, as we talked about briefly earlier, hedging, fixing trades that go wrong, taking profits. We can help you learn to ring the register. We have 4 different programs that we offer here at Dorian Trader. These are 3 that I'm going to briefly talk about. We got an options trading training cohort. It's a 3-month group learning environment that you can learn the 1DT strategy, the 7DT strategy, safeguard strategy, and a few other things. We have a disciplined trader program that you'll meet with me one-on-one for 6 months to learn how to be a disciplined trader. And then we have our biggest program that we call the apprenticeship program. That's where I'll fly out to you, spend 14 hours with you in person, and then you'll basically follow me around for a year to learn how to be a full-time trader. If you want to be a full-time trader, this is the program. We call it the apprenticeship program. Okay. You can learn more about this at doriantrader.com. Just go on to memberships. But what we pitch on our webinars almost 100% of the time, if not 100% of the time, it's our trading club. This is the entry. This is how you get in and understand and learn and see what we're all about and see if we are full of crap or if we're the real deal. Our trading club is unique. We believe it's the most robust, interactive trading club on the planet. And the reason why we believe that is if you sign up and you become a trading club member, you'll get course 1 in our video library, which is hours of unique study and videos and quizzes. You'll get 25 plus hours a week of live programming. For example, we're live on Monday mornings, afternoons, and evenings, and that's pretty much throughout the week. Sometimes we're live on Sundays. When you join our calls, it's not like this webinar. You will be able to not only chat, put stuff in the chat area, you'll be able to unmute your mic and present questions. So we can't cherry pick your questions by looking at the chat. No, you'll be able to unmute your mic and interrupt the instructor. And we encourage that because people learn that way. You learn that way, and others learn from your questions as you learn from their questions. You'll be able to share your screen. So if you need to learn how to put on a trade, you can share your screen. We can walk you through it. If you need 911 help, every member of Dorian Trader gets 911 help into perpetuity. You go on a call, we have 2 different rooms. We have a main room, which we're teaching a lesson. Then we have a 911 room. You can go into that 911 room, get your help, and then come back to the main room. You have that ability into perpetuity if you need help. Obviously, we want to help you learn how to not need 911 help, but we all at times need some assistance perhaps. Then we have what we call follow, learn, and earn. This is where you can follow the trades that I do. You can learn from those trades by asking questions, asking me to help you put the trades on, and then you can earn. We do 5 of these trades every Wednesday. We do 4 in the morning call and we do 1 in the afternoon call. You can learn this way. And we do not touch the trade, or at least I do not touch the trade again until the following Wednesday. So you don't have to worry about, did you miss an alert? Did you miss an email? Did I make an adjustment? No. My promise is to our members is that I won't touch that trade again until the following week. So you'll have the opportunity to change the trade and get the help that you need? What other mentoring firm out there? We dare you to go check. You will not find any other mentoring firm out there that gives you what we just talked about for our trading club. And as I indicated earlier, you can get that for a trial period of $30 per month. Yes, it's a shocking offer. $30 per month for 3 months. After that is our regular discounted price of $125. Ernie's putting a link into the chat area that you want to click that link. It's going to open up a new page so you won't leave this webinar and you'll be able to join us. If you're on YouTube and you're interested in joining us, you can click the link in the description area. I believe it's a link in the description area, and you can join. It's an automatic coupon already there. Okay, it's a coupon. Excuse me, the coupon code is already connected to the link, just like it is in the chat area. You want to sign up to start to learn. You'll be on the call tomorrow. You'll be able to see us do day trades. You'll be able to see us do a bunch of trade ideas, what we call alchemy of a trade on Thursday mornings. You can get started as early as tomorrow with your learning journey. $30 per month for 3 months. After that, $125. Click the link in the chat area. If you sign up before this webinar is over, you'll get the Options Bootcamp mini course for free. This is a very, very comprehensive course on the basis of options. It's going to teach you all those 3 pillars that we talked about earlier in great detail. It's going to teach you the basics of technical analysis, and it's going to teach you or present 10 questions that you need to have answers to as a beginner. You're going to get that for free. Here at Dorian Trader, you guys, we are all about our mission. Our mission is to eliminate failure when learning to trade. We do not want you to blow up your account to learn to trade like I had to do and like so many of you on this call probably had to do. We believe that's an antiquated way to learning how to trade, and we want to avoid it, and we've set up everything at Dorian Trader to avoid that. We want you to get the help that you need to be able to be successful without losing your hard-earned money. We talk about doing that by introducing the 3Ds: desire, dedication, and discipline. This is what you'll hear a ton at Dorian Trader. Desire. You have some desire because you're on this webinar, but is it a deep commitment to becoming a skilled and consistent trader? Present that question to yourself. Dedication. The work ethic to show up, study, and follow the process daily. And then the most important D, or maybe the most important D, or at least I think it's the most important D, is discipline. The ability to follow rules and stick to a plan and manage risks at all times. Manage risks at all times. Here at Dorian Trader, we like to say, manage the risks. Think about what you can lose before what you can win. If you take care of the losers, the winners will take care of themselves. We're already giving you the odds. We're already putting the probabilities on your side. You just have to have the discipline to follow the process. So we have a strategy here that we call the safeguard strategy that we introduce to people. This is a strategy we believe you will never blow up your account doing. And we wrote a book on it. It's called This Strategy Killed the Wheel. The Wheel Strategy Did. The Safeguard Alternative You Need to See. If you sign up before this webinar is over, you'll get this book as well for free. All right. It's a short read. It's a short read on purpose, but it's powerful. You'll get this book for free as well if you sign up before this webinar is over. Now, is it better to sell a put spread in the SPX cash index or in the ES futures index? So as we indicated earlier, it's the S&P 500. It's all the S&P 500. We believe the answer should be based on capital efficiency if all else was equal. So let's break this down really quickly to get a little comparison. I told you we teach you how to trade options on futures and options on stock here at Dorian Trader. So SPX is considered options on stock, even though it's a cash settled index. Let's go to May 15th. And let's do a put spread, and let's do the put spread way down here at the 57.50. basically around, give or take around a 10 delta. Okay. And let's do a 25 point widespread, right? This is San 11, it's semantics. Okay. Well, if you did this trade with the SPX, you'll make about 100, you'll collect 165. Tasty Trade is saying you got a 91% chance of winning. I just say 90 if it was a 10 delta. Got a 90% chance of winning at expiration. Okay. And your max loss is 23.35 and your buying power is 23.35, right? So we said capital efficiency. If all else was equal, it's capital efficiency. So in this example here, if you did this, if you take the 125 and you divide it by the 23.35, that's 7% return on your capital for the SPX, right? So 7% return on your capital. Keep that in mind. 7% return on your capital. So if we go over here and we look to the ES and we go to May the 15th as well, and we do the same thing and we go down to the 57 57.50, which is right here, and we do a 25 point wide. It's the same thing. I know it looks different, but these strikes are 25 point wide. Okay. And you have to do two contracts to make it equivalent because the ES is half the size of the SPX. You'll learn all this stuff if you join the Dorian Trader. So in this example here, we're collecting 175, which is basically the same as we were collecting on the SPX. And the max loss is basically the same, right? It is the same, 23.35, right? And but look at this buying power. Look at this buying power that they're requiring on the ES options. It's $515. So you got the 165 divided by the 515. That is 32% return on your capital. These are the kind of things you'll learn at Dorian Trader. We will help you make money the most efficient way, the safest way. We're all about teaching you how to make money to at least supplement your income in a meaningful way by understanding how to use strategies that benefit you. You want to sign up, you guys. You want to sign up to learn so much more. You want to sign up. All right. So if you're hungry for more, go to DorianTrader.com, click under events. You'll be able to see other webinars that we do. You guys, we teach on our webinars. We're not only different in our trading club, we're obviously different in our webinars. Yeah, we pitched for you to join us, but you've learned something tonight. Even you advanced people, I bet you've learned some stuff tonight. Now, some of you have already signed up, but it's a few of you still on the fence. So I'm going to highlight a few more things before we jump into the Q&A. If you decide to join our trading club, you're going to get one-on-one onboarding, which is a $300 value for free. Onboarding, not a sales pitch. We want you to be successful, so we have to set you up. We have to get you started in a successful way. One-on-one onboarding, $300 value. Access to course one in our video library and Dorian School, $700 value. Live morning market briefings and trade ideas, $2,000 value. Like I said, we got Alchemy of a Trade tomorrow morning. Access to the Beginner's Hub, a weekly small group teaching class, $400 value. That's tomorrow night, every Thursday night. You're a beginner, you come with all your beginner questions. We're going to answer them all. We want you to be successful. You got no business not being successful if you join our trading club, if you join Dorian Trader. Live teaching classes on Wednesday and Sunday nights, $800 value. Admission to the trading floor every Friday, $400 value. This is our most comprehensive trading program. Trade ideas emailed every Tuesday and Thursday, $800 value. 911 emergency help, $300 value. But that's more because you get it into perpetuity. It's actually more than $300. Cloud recordings of all live programming, $800 value. Platform setup assistance, $300 value. Unlimited questions via email, text, or phone, $300 value. Complete access to the member-only Discord. It's no one on our Discord. There's no one on our Discord channel that's not a member. That's a $200 value. You get over $7,000 of value, you guys. Over $7,000 of value for $30, a $30 trial per month, $30 per month for 3 months. If you go the whole 3 months, it's a $90 investment. Way, it's way worth that. We're giving it away for you to join our trading club and become a member, and you'll grow from there. It's our job to keep you as a member forever, so we have to provide value that represents forever. You can cancel at any time, but we want you to once again be a member forever. So we always trying to provide that value. After the 3 month trial, it's 125 per month. That's our regular discounted price. If you sign up before this webinar is over, you're going to get that options bootcamp mini course for free that we talked about earlier. And you'll also get this strategy killed the wheel. This is our book that we wrote. You'll get that for free as well. All right, Ernie, jump back on. Let's answer some questions here. Let's see what we got going.
All right, here I come. First question, because somebody was signing up and they missed what you said. What's better, the SPX or the ES?
So the
Today's put
ES,
spread.
the ES was significantly better because it's the cash efficiency to how you use your capital. So we did the equivalent trade. The return on your capital was 7% for the SPX. It was 32% for the ES. So the ES allows you to have what is called span margin. It's like portfolio margin. It's the original portfolio margin. Everyone gets it regardless of your account size. If you have portfolio margin, it'd be closer to that ES percent return on capital thing, but I still believe the span margin is better. But if you're going to qualify for portfolio margin, you need to have a bigger account. On Thinkorswim, you need to have at least $125,000 account to start. On Tasty Trade, at least $175,000 account to start. And I believe on Interactive Brokers, at least $100,000 to start to get portfolio margin. Span margin, you can have $5,000 in your account. And that's what we recommend here at Dorian Trader, to start with 5,000. And you can have this odds. You can have these great return on capital. You can build upon it each and every week, each and every month. You can grow your account with the right guidance.
Cool. I love this question. We don't get it too often because sometimes you address it, but go back to the Tasty Trade brokerage account, open up an
Mm-hmm.
option chain.
Mm-hmm.
And here's the question. Why are strike prices descending? To me, it seems the strike prices should be ascending, like price ascends on a chart.
So to me, that's a really good question. But to me, the way they did it was pretty brilliant because on Tasty Trade, they allow you to switch it, but it just doesn't work right if you've learned on the normal way, is that it's the way you set this up, going up on your screen is actually going down, as you guys can see here, 625, 6625, 6600, and so forth. That's actually going down. And then going up is actually going down on the screen, 6650, 6665. So that's going up. But it's pretty brilliant how they did it, in my opinion, because it's it feels backwards, but once you learn the option strategy, it's gonna feel more backwards doing it if it was going in the right direction. And so, for example, this is how it looks if it was if it's going up and down. And so it's really kind of throws you off because you're at the money, and your in the money is obviously is flipped, and then you have to go like this, and it's all the professionals and everyone, that most people that do this and the most option chains you see, you're not going to see it like this, so it's going to be harder to learn and see if you do it this way. So you have to go the traditional way of just learning it, this how it's set up here.
Yeah, I've never heard of anybody that's flipped it intentionally just because we've all learned and trained on it the way it's set up. But it is
Correct.
interesting if someone does it that way.
So the reason why it's that way, you guys, is that years ago, this is how they had it on the trading floors back in Chicago and so forth. And so people like the founders of Thinkorswim, they set it up this way. They were the first to do it, believe it or not. With Thinkorswim back in 2000, maybe it was one in 1999, and And the other platform, the other brokerage firms, they were like, well, why do you do it that way? And now everybody does it this way. So to me, it makes a lot of sense because it's uh, it's the way I've learned on it, and just the dynamics of how you set it up. It makes more sense to me, um, of
Yep.
how it's done.
Let's talk about assignment real quick because there's a question in the open questions that I think, if I interpret it correctly, is
Mm.
if your put that you sold stays out of the money, you don't get assigned. Is that correct? And what happens? You get to keep the money that you sold in your account, but what happens if it goes in the money? What happens to the trade?
So when you sell a put spread, I'm just picking this right here. If you sell a put spread, you have an obligation and you have a right. So at with it over the next 51 days, the most you can lose is between this spread, right? So in this example here, the most you can lose is, I just picked these numbers, you guys. The most you can lose is 35.87 over this next 51 days. So regardless if it drops all the way down here, or regardless if someone's assigns you this strike here because you have the obligation there, your risk is still only 35.75. But if this is the caveat, if it expires though, and it expires in between these two strikes, then you have risks all the way to zero still, because you have the obligation to buy the shares at the 65.25, but this put has already expired. It's gone. It's history. It's no longer there. And so if the market gaps down or falls a ton, or the stock that you have falls a ton, you can lose a lot of money that way. So always with bull put spreads, or just put spreads, regardless, just get out before expiration. Right? Get out expiration or roll it, and that's a whole nother topic. It's a little bit more advanced. You do not have to you do not have to have any additional risks if you just take your profits or roll the trade before expiration.
Okay, margin. I know you covered a little bit, but
Mhm.
on a normal trade or the put spread differential, what type of money do I need on any one of these trades?
So if you're going to do it on options on stock and you're using what is called regulation T, or regular T margin, then you're going to have to put up the your max loss from the spread. So for example, if I go back to this SPX and I just pick anything here, and I just say I did this spread here that was 10 points wide. Well, I'm collecting that's actually 20 points wide. Or excuse me, that's 10 points wide. I'm collecting five. Something is off here. All right, let me do that again.
You've got four
Yeah, I
legs.
had
You had
something.
four
Yeah,
legs
I had
open.
something else. I had something else there. So this is 10 points wide. And so you have to put up your max loss. So if you had 310 here, your max loss is 690. So you have to put that up. You have to as your max loss. That's always going to be the case. You have to put up your max loss when you do a spread, when you're using regulation T or regular T margin on any stock, right? Anything that doesn't have a forward slash in front of it. When you're doing something with the forward slash in front of it, then it's going to be more like portfolio margin. It's called span margin in the options in the futures market, but it's basically basing your your buying power off your portfolio. What's in your portfolio? What they deem is the real risk based on your overall portfolio. And so it's most likely going to be, if it's not a zero DT trade or a short-term trade, it's most likely going to be significantly better buying power than doing it on options on stock.
Lots to learn. Lots to learn.
Yes.
Okay, I love this question. Somewhat, for our benefit, but I'll
Mhm.
read it. Let me see if I can find it. I'm new to trading. What are your methods to take a person from the beginner stage to a knowledgeable trader? If I sign up, would I only be watching a series of videos, or are there in-person classes, one-on-one training? Please explain. This was right before you went through the offer. but I think
Okay.
it's worth just kind of giving your flavor on how
Okay.
much
Yeah.
interactivity there is.
Yeah. So what will happen is that when you sign up, all you have signed up to this point, you're going to get instant access to the member dashboard. And on that member dashboard, you're going to have these two red banners that say "Click here to get started." Once you click one of those, it's going to give you these steps you need to take. And one of the steps is on-demand onboarding. And then we have group onboarding on Tuesday nights. And then we also have one-on-one onboarding. And then we have on Thursday nights Beginners Hub, so you can get your questions answered and share your screen. On all of our calls, you can unmute your mic and ask your questions. And if you need some assistance, like putting on a trade, you can share your screen and we can do that for you. If you have 911 issues, you can jump into the 911 room and get your help and then come back to the main room. We have morning, afternoon, and evening classes almost every day of the week. And sometimes we do a Sunday class. And so you'll have access to us. You'll be able to email support and get your questions answered. You'll actually get my cell phone number. A lot of members text me and get questions answered. I try to answer as fast as I can. And you will be able to do stuff in person with us. Like for example, I'm going to be live on Tuesday in Dallas. So if you're in the Dallas area, I encourage you to come out. And then we have an annual member retreat that is in this year is in Las Vegas. And then we just do in-person stuff across the country. And you can share your camera on our calls and things like that. So you will get to know us. We'll get to know you. And if you want to learn, if you really have a deep desire, you're going to learn. You're going to learn how to make money. You're going to learn how to, at the very least, supplement your income. And it's so much more than what I'm saying right now that's a part of our club because we structured everything to make sure you have the ability to learn and get the questions that that you have answered. And so, do we have group learning like cohorts? Yes. Do we have one-on-one options that you can do? Absolutely. We got all of that, and you'll have access to those things.
All right, I'm going to test your mentoring skills right now with this question,
Hmm.
O'Brien.
Okay.
Here it is. With what you have on the screen right now, which is
Hmm.
perfect,
Hmm.
we are placing a bull put spread. You agree, right?
Yes, sir.
Okay. We're selling at high and buying at low. Technically, we are buying at a high strike and selling at a low strike. That makes sense? I'm a bit confused.
So we're selling at a high strike, yes, and that strike because it's a higher delta and it's closer to at the money, like as I was pointing out earlier, it's it costs more for this strike, and the strike that we're buying is further from at the money, and it costs less. So this is going to be an overall credit to your
Great.
account, as you can see down here, to CR. So what's your question? I don't know if that was the question or
Well,
not.
what you did is awesome.
Mhm,
It's they wrote something down. I think they're confused. They're new to trading, and I just
mhm,
wanted you to repeat it in a
mhm,
way that, quite frankly, you did it a little bit differently so that someone can understand. Um,
mhm.
you're going to attack the teaching process from whatever angle you have to get this into somebody's head. That was my point. So good for you. Good
So,
for you.
so absolutely, you guys. So, what a lot of times you'll hear me say on the calls, if you decide to join Dorian Trader, that okay, let me know if you don't understand what I'm saying. Maybe I can articulate it a different way. And most of the time, I can articulate things, two or three different ways, right? But options are hard to learn. Everyone, you can't expect it to be something you can just fall out of bed and get, but it's worth learning. You're not going to have to go back to school for 4 years, but it's going to be a lifelong learning journey. But we give you a 3 month trial period for a reason. You're going to know you can do it after the 3 months. Are you going to be an expert? Absolutely not. You're not going to be an expert, regardless how smart you are. You're going to be far from expert. But you're going to have the conviction. You're going to have the motivation. You're going to be empowered to know that you can do this. You're going to see a lot of our members making money. And it's gonna encourage you to say, okay, I'm in a community that I can unmute my mic, I can ask questions, I can hear other members, I can hear their their wins, their struggles, their whatever. And it's going to be definitely motivation for you to keep on pushing, keep on learning. And we're gonna be there for
Perfect.
every step of the way.
Let's wrap her up. O'Brien, we've kept everybody a little bit over, but that was great conversation. Thank you. So, final word, sir.
Okay, we're gonna give you 5 minutes into after this call to sign up, and you'll still get this deal. 5 minutes, just in case you were scared or you had to hear a little bit more through the questions before you were going to sign up. We're going to give you 5 minutes. If you sign up before this, within the 5 minutes after this call is over, you'll still get the extra deals. You can sign up after regardless, but you won't get those extra deals. Now, if you do not want to sign up yet, and that's great, that's fine. We encourage you to at least come back to the webinars, learn some more. Go to DorianTrader.com and sign up for the other webinars under events. Just click events at the top. Okay. And so if you go over there, if you go here right now, I'm going to bring this up really quickly just to
This
show
this
people.
this coming Saturday, I'm teaching one.
So yeah, so this is our website right here. And if you go to events right here, just at the top, you'll be able to see all the different events that's coming up, right? You see that dissecting the put spread that you're on right now, then you see these other ones. Okay. Now, also, if for some reason that link didn't work in the chat area, or if you didn't want to click the link, I don't know why, but I just say that that's the case. You can go anywhere on our website for the next 5 minutes after this webinar is over. Click this link, and it's going to give you the deal as well. Okay, click this banner on anywhere on our website. It's going to give you that deal, but that's going to go away. So you want to do that within the next 5 minutes. All right. So we thank you for joining us today. Super appreciate it. I know you have so many more options out there. You got so many more, choices, so many other things you can be doing, like, watching Netflix or whatever the case may be. But you will be you'll be more than happy with yourself. You actually be a little sad that you didn't learn this a long time ago if you decide to join us. So looking forward to getting to know you, if not now, in the future. So thank you again for joining us this evening.
Have a great evening, everybody. See you soon.
See you soon.